Decoding the gateway. Identifying and evaluating initial public offering, IPO, opportunities. Introduction. The allure of initial public offerings, IPOs, beckons investors with the promise of participating in the early stages of a company's public journey. Yet, the IPO landscape is rife with complexities, risks, and opportunities that demand astute analysis. This exploration delves into the strategies and considerations investors should employ when identifying and evaluating IPO opportunities. Navigating the exhilarating yet precarious terrain of newly listed stocks. The IPO unveiled. An IPO marks the transition of a privately held company to a publicly traded one, allowing it to raise capital from a broader pool of investors by issuing shares on a stock exchange. For investors, IPOs represent a chance to acquire shares in a company before they commence trading on the open market. The allure lies in the potential for significant early-stage gains, but with this potential comes inherent risks that necessitate a careful approach. Identifying promising IPO opportunities. The quest for lucrative IPO opportunities begins with a vigilant eye on the market landscape. Investors can identify potential candidates by monitoring the IPO pipeline, a list of companies preparing to go public. Financial news sources, regulatory filings, and updates from underwriters and investment banks provide valuable insights into upcoming IPOs, offering a starting point for investors seeking exposure to new and exciting ventures. Additionally, scrutinizing the motivations behind a company's decision to go public is crucial. Is it seeking capital for expansion, debt reduction, or employee stock options? Understanding the underlying reasons for an IPO sheds light on a company's strategic goals and can help investors assess alignment with their own investment objectives. Evaluating the IPO landscape. As investors sift through the myriad of IPO opportunities, a comprehensive evaluation process is essential. Traditional valuation metrics, such as price-to-earnings (PE) ratios and earnings growth, play a pivotal role in assessing the attractiveness of an IPO. However, given the unique characteristics of newly listed companies, additional considerations come into play. 1. Financial health and performance. Analyzing a company's financial statements, revenue growth, and profitability is fundamental. Investors should scrutinize financial metrics over multiple quarters or years to discern patterns and evaluate the sustainability of a company's performance. While some IPOs may represent high growth, loss-making ventures typical of technology startups, others may showcase a proven track record of profitability. 2. Industry dynamics. Evaluating the industry landscape is crucial, as market conditions can significantly impact a newly public company. A robust understanding of the industry's growth prospects, competitive forces, and regulatory environment informs investors about the potential challenges and opportunities the company may encounter post-IPO. 3. Management team. The strength and experience of the management team are pivotal factors influencing a company's success. Investors should delve into the backgrounds of key executives, assessing their track record in steering companies through challenges and capitalizing on opportunities. A seasoned and visionary leadership team enhances the likelihood of a successful post-IPO trajectory. 4. Use of proceeds. Scrutinizing how a company intends to use the capital raised from the IPO is a key aspect of due diligence. A transparent and well-defined plan instills confidence in investors, as it demonstrates a strategic approach to deploying funds for growth, innovation, or debt reduction. 5 Market conditions and timing. The timing of an IPO can significantly impact its success. Investors should gauge the prevailing market conditions, economic climate, and overall investor sentiment. An IPO launch during a bullish market may generate more enthusiasm and robust demand, potentially leading to a successful debut. Mitigating risks in IPO investments. While IPOs offer enticing opportunities, they also carry inherent risks, and investors must adopt risk mitigation strategies. Diversification is a fundamental principle, as allocating too much capital to a single IPO amplifies exposure to idiosyncratic risks. Additionally, setting realistic expectations and acknowledging the volatility associated with newly listed stocks can temper the impact of short-term price fluctuations. Case study: the tech unicorn IPO. Consider the IPO of a tech unicorn, Tech Genius Inc., which has captured the market's attention. The company, known for disruptive innovations and rapid revenue growth, decides to go public to fuel its expansion plans. Investors eagerly await the IPO, enticed by the prospect of participating in the next big tech success story. Upon evaluation, investors uncover promising financials, a visionary leadership team with a successful track record, and a clear plan for utilizing IPO proceeds to invest in research and development. However, they also recognize the inherent volatility in the tech sector and the potential for heightened competition. As the IPO day approaches, market conditions remain favorable, with a bullish sentiment driving demand for high-growth tech stocks. Tech Genius Inc. goes public at a price that reflects both its potential and the prevailing market dynamics. Investors who conducted thorough due diligence, assessed the industry landscape, and diversified their portfolios are better positioned to weather the initial market turbulence. They recognize that, despite short-term fluctuations, the long-term success of their investment hinges on the company's ability to execute its growth strategy and navigate the competitive landscape. Conclusion: identifying and evaluating IPO opportunities is a nuanced art that blends financial analysis, industry insight, and risk management. Investors seeking to capitalize on the potential offered by newly listed stocks must approach the process with diligence. Recognizing that the allure of early-stage gains is tempered by the need for comprehensive due diligence. By navigating the IPO landscape with a discerning eye, investors can position themselves to harness the opportunities presented by companies on the brink of their public debut. Ensuring that their investment journey begins on a well-informed and strategic note.